I'm going to blow up that red square because it's a little hard to see. But in that red square is a piercing pattern. See that vertical blue line is showing us where the target is. I just expanded. So what I've done is I've expanded this red square into this to show you the piercing pattern. Okay. Why would you, in spite of the piercing pattern, I would definitely consider taking profits there. Why would you not be going long? Think about the change of polarity. Right, the change of polarity. See how it broke under a support area? Old support should become new resistance. Once it got above that old resistance, you actually had a crack and snap. I don't know if it ultimately got to the top end of the range, but. Oscillators. Okay, this is really not an intense course on Western technicals, but I know many of you use oscillators, so I wanted to make sure I touch on it. And an oscillator is mathematically derived and includes RSI, stochastics, and so forth. And it's very objective. Okay, there are specific numbers. They're mathematically derived, so there's no room for subjectivity as far as the numbers are concerned. How you interpret oscillators, there is some subjectivity. Okay, separate from the price action. So for those new to oscillators, you're going to have the price on the top and the oscillator on the bottom. And oscillators really should, most people don't remember this, but oscillators really should be used in lateral markets. You should not have strongly trending markets. We'll look at an example of this in a couple of minutes. People forget about that. And includes these oscillators, stochastics, RSI, the MACD. The etc. oscillator is very rare. How many use oscillators here? Okay. This will be interesting. How many use RSI? Okay. Okay. Stochastics? Okay. Both of them? Wrong. You shouldn't. You should not use the same. You should use one oscillator because you're going to totally confuse yourself. You should be using, when you're trading, again, this is a different course than what I'm teaching here, but when you're trading, you should be using independent information, right, for lack of a better word. You should be not using 2 or 3 oscillators. You should be using something that follows price action, an oscillator, and then something not related to an oscillator, maybe a moving average. But you shouldn't be using 2 of the same thing because you're totally going to get confused. The RSI is going to show you one thing, and the MACD is going to show you another. If you really want to use an oscillator, which is fine, pick one that you're really comfortable with. Don't do 2 or 3 or 4 because they're not giving you any more information, and in fact, it's going to confuse you. Bollinger Bands would be another add-on also. Yes, it depends on the time frame. You may want to, right, okay, so that's a point. Shirish mentioned it could be different time frames. So if you're using RSI in one time frame and stochastics in another one, that's fine. But don't use RSI and stochastics in the same time frame, or the MACD. Now keep in mind, oscillators, they're good, but they're lagging indicators. All right? But let me show you the main uses, the way we're going to talk about them, since so many traders will use them, is gauging if the market is overbought. Essentially, an oscillator, no matter which one you're looking at, is gauging the momentum of the move. So has the market moved up too far, too fast? And another major way is divergence. So let's look at using oscillators with candlesticks to increase the probability of the candlestick signal working out. Remember I don't remember which chart we looked at, but we said one way to increase the likelihood of a candlestick signal calling reversal is if the market is overbought or oversold. We could use oscillators to gauge overbought, oversold. So this happens to be RSI, and usually what is it, 70–80%, the market is viewed as overbought. So with this first doji on the left with the green arrow, is the market overextended based on the RSI? Yes. Therefore, I would probably, this is not enough reason to go short on the doji, assuming it's not confirming resistance, but it does increase the likelihood of a sell-off. Now, look at the other doji. Now, is the market overextended? No. And this is one way, one of the challenges we may have with is, for example, a hammer in a downtrend or not. What you could do is kind of a way around that is look at the hammer and look if the market's oversold. Right? And if the market's oversold and we have a bullish hammer, the odds of a turn are much higher. So the second doji here, although it may not be too much of a box range, the three candles before looked like kind of a box range. But ignoring that, we could look at the oscillator and say, okay, the market's not really overextended. I'm not going to pay too much attention to this doji. So that's overbought, oversold. Divergence. Okay, just very quickly for those a little bit new to oscillators, divergence is bullish and bearish divergence. Bullish divergence is when the price makes a new low. Now remember, the oscillator is separate. It's on the bottom of the chart. At the time the price makes a new low, the oscillator does not make a new low. That's called bullish or positive divergence. Many, many traders will use this. Negative divergence is when the price makes a new high for the move, and the oscillator does not confirm it. See, because the oscillator measures momentum, we want to see the momentum in line with the price action. So if the market's making a new high for the move, we want to see the momentum making a new high for the move. If you get divergence here, it's a sign that the market is vulnerable. So here on the RSI, see how the hammer made a new low for the move. What happened with the oscillator? Did it make a new low for the move? No. Once again, I would never use oscillators by themselves. The Japanese say the thunder is loud, but there's little rain. Okay? The oscillator is a potential setup, but how do we know that the market's going to turn? The odds of the turn is by using the candlesticks. That, to me, is the final filter. Use the Western technicals to give you the alerts, the oscillators, the support and resistance, but the real trigger, the real confirmation comes with the candlesticks. What else is also positive about this hammer? And I don't expect you to pick it up easily, but look at the support level. The prior support. Yeah, one of those kick things. Yeah, cracking, whatever it doesn't matter what you call it, as long as you know what it is. I don't care if doesn't matter the name. You call it the water fountain. I don't care, as long as you understand the concept. The market broke under the support. What happened? You couldn't hold it. What's your target? Can you see the number? What would be your target on that crack and snap? The most recent high, right, which is about 20, which is this? This is the pound. Oh, this is actually the pound yen. So it would be, yeah, right up there. That would be the target. Okay. And what's the stop? Intraday, the lower the hammer. In this case, because it's a crack and snap intraday. Why would you be looking at this hammer here, but even before the hammer, the market's gave you another potential buy signal. And what was that before this hammer? Long shadows. What else? Long shadows is certainly plus. Harami, and what else? Hammer. It's a hammer. Yeah, another hammer. The low of the hammer is a support level. Double bottom. But the low of the hammer is support area based on the close. But all your answers are correct. Long lower shadows, the Harami pattern. So, okay, for those who use stochastics, essentially, for those new to stochastics, you have two lines. You have a percent K and a percent D. Percent K is faster line. If the percent K crosses above the percent D, it's a positive signal. Yes. Was there a question? Okay. So on slide 133, what are you asking about the bullish engulfing pattern? Bullish engulfing pattern before the doji. Oh, over here.